I'm George Ogilvie, President and CEO of Arizona Sonoran Copper Company. Arizona Sonora has the old Sacaton mine, which is located in Arizona in the US of A. It's a large former producing copper porphyry system. Our goal over the next 5 years is to de-risk the mine, take it through the various technical studies, put in place the project financing. And we believe within that time period, we can bring the mine into commercial production, producing somewhere initially between 25 and 40,000 short tons of copper cathode over an 18-year initial mine plan.
George, thank you very much for the introduction. Really good to meet you. Really good to learn more about Arizona Sonoran. The theme for this interview is really about contrarian investing. And in some ways, it's a little bit frustrating because as a mine developer, you've just laid out a 5-year mine plan. And yet we do live, a 5-year development plan for an 18-year mine plan. And yet we do live in immediate markets. Perhaps I could just start with a question. If I talk to you about contrarian investing, what would that mean to you? What would be the first few things that kind of spring to mind when I mentioned that idea to you?
Well, I mean, as you've touched on there, I mean, obviously, we're in difficult times. Economies around the world are really struggling. GDP is shrinking. And particularly in the copper space, the copper price is very much affected by the general economy. Copper tends to be a bellwether for the economy. So with economies heading into a downturn and likely into a recession, a lot of investors out there might think that this is not the time to actually be investing in copper. But in my opinion, you really need to take the blinkers off and think a little bit more medium and longer term as to what is actually going to be the copper demand, in the next 2 to 3, 5 years and 10 years out. And when you start to take that wider sort of perspective on the copper market, you quickly realize that in actual fact, now is precisely the time when you have to be investing in copper so that you can be prepared for the next bull market, which is actually coming, in my opinion, in the next 2 to 3 years.
Well, I'm an avowed copper bull. You're preaching to the choir in that sense. I'm exploring for copper, and I'm a great believer in the fundamentals. But the heritage of the company. I mean, I look at your shareholder structure. You've got 35% with Tembo. You've got 27% with institutions. And just talking about kind of a long-term thematic. Presumably, this was a Tembo. Tell me about the origins of the company. Did Tembo gestate this? Was this a kind of one of the ideas of Tembo in an even longer term thematic on the copper space, or did you bring them in as part of the listing process?
Yeah, so it was actually my predecessor, John Antwi, and former chairman Paul Hoot, who's with Karora Resources.
Oh yeah.
They had formed the then Elam Mining as a private company. And John and Paul were able to negotiate with the Arizona State Trust that was actually managing this asset and the remediation of the site. They were able to negotiate with the State Trust to acquire this asset in late 2019, which they subsequently did by paying the state $6 million US dollars. So we were formed as a private company. We had this asset. And then the company was then looking for private investors. And fortunately, we were able to bring Tembo Capital to the table. And they supported the company through its private rounds of funding. And of course, we brought the company to the public markets in November of last year when we listed on the Toronto Stock Exchange. And between then and private placement that we did in May of this year, Tembo Capital has invested approximately $40 million US dollars, although they've seen some dilution of late. And today, as you rightly pointed out, they're a 35% controlling shareholder within the company.
Did they increase their position in the most recent round, or did they just kind of hold their corner, maintain their interest?
They put in $6 million in the recent private placement, but it took them from 38% shareholding down to 35% shareholding. And when we IPO'd the company in November of last year, at that time, they were approximately a 45% shareholder. I think they put in $10 to $11 million as part of the IPO, but as I said, it then brought them down to about 38%. So we're in a good situation in that Tembo Capital has been extremely supportive of the management in the company. They've assisted us and stood their corner with respect to financings, but at the same token, they've actually allowed themselves to be diluted down. Some people may, particularly some institutional buy-side accounts, might actually look at the share capital structure of the company and not be able to invest when there's such a large controlling shareholder. So I think over time, as we continue to raise additional monies, Tembo will continue to support the company, but ultimately I think we'll see them eventually diluted down below 20%, which should then help attract additional buy-side institutional accounts and further help with trading liquidity.
On the Toronto Stock Exchange, there's that crucial kind of 20% threshold, isn't it, when it changes from a controlling shareholder to a rank and file shareholder?
Exactly.
So you'd expect kind of long-term target for them is 19.99% and then maintain their interest?
Yeah, and they've followed that model with other companies in the past. 5 years ago, they were heavily invested in Ero Copper, which is a Brazilian copper play, approximately 50,000 short tons of annual copper cathode production. They had gone into a former producing mine in Brazil and obviously, reevaluated it and got it up and running. And several years ago, Tembo was a 20+% shareholder there. They supported the management of the company. Over time, they allowed themselves to be diluted down. And ultimately, when the timing was right for them, they exited the story without an overhang on the share price. And that company's done exceptionally well in the last 5 years.
Yes, I mean, I think if you can get into that range of production, that's a really solid kind of low to mid-tier copper production. It's That's ultimately where I think we'll end up with Park Salyer ultimately coming into the equation. When we put out our PEA in August of 2021, which was purely on the Cactus Project, which involves the mining of a surface stockpile, a pit layback at Cactus West, and there's an underground component there known as Cactus East. The average annual production was 28,000 short tons of copper cathode production, with a peak around 40,000 short tons, and the mine life was 18 years of production. I think with Park Salyer coming into the equation now, we're going to try and see if we can get the average annual production up to that 50,000 short tons, and maybe even a peak in and around 60 to 70,000 short tons. And I think we'll see the life of mine now begin to exceed 25 years. So it starts to get up to a size and scale that certainly would be appealing to mid-tier copper producers and potentially some of the larger miners that are out there. I've seen a few gold companies, different animals I know, but a few gold companies in this market environment actually putting a hold on the bigger project exploration dreams and saying, actually, we're not being rewarded by adding exploration or adding new ounces. We're not being rewarded by expanding the envelope of mineralization and adding resource ounces. But so in fact, what we're going to do is going to go for a smaller, lower capex project, and we're going to push towards production. But what you've just described there is actually almost the opposite. You've talked about adding in Parks and Salyer.
Yeah.
Was that a market decision? Was that affected by availability of capital or the mood?
I think so. Yeah. I mean, one of the criticisms we've heard of the project, since we put the PEA out, was that yes, the economics look quite attractive, and it's in a great jurisdiction, and you've got significant permits, including the right to take water, and there's an abundance of water. But the one criticism we've heard is that the production profile is relatively small. So we've tried to address that through Park Salyer, or we hope to address that through Park Salyer, as I said, to push that annual production up, hopefully north of 50,000 short tons. which seems to be a bit of a threshold that, if you can get that and have a 15, 20 plus year mine life, suddenly now you'll attract the attention, as I said, of some of the mid-tiers and maybe even the seniors. The point you were going to raise you raised on the gold companies is really interesting as well, because what we're seeing happen now is, gold companies typically used to get a superior multiple. And there was always an argument that a gold company should never divest and get involved in some of the base metals, and particularly copper. Usually when you find these copper and gold sulfide deposits, the two metals actually go hand in hand with one another. But for many years now, the gold companies no longer get that superior multiple. And there's lots of questions being raised about investment in gold companies. Do we need another gold company when we start to consider the greenhouse gas and the ESG angle, with respect to those business models? So we're actually now starting to see a lot more gold companies actually pay attention to the copper space. And of course, recently we had Agnico Eagle announce a JV 50-50 with Teck on the San Nicolas copper project in Mexico, which is a pure copper play. And we started to see other gold companies, looking at, copper assets. And I think that's extremely good news for, the group of companies that are explorers or near-term developers, getting close to construction decisions, because we're very few and far between. There aren't many quality assets, quality projects out there. And if there's going to be increased competition over the next 5 years or so for those projects, those assets, as we know, competition drives prices, and a more competitive environment can, realize itself with exceptional gains for the shareholders of the companies.
And it's not just that competition for the asset, it's also the skill set that goes with it. Because one of the things about a Heap-Leach gold project or a simple CIL gold project is that it's very easy to do. The capex is relatively low and the technology is relatively simple. The more successful 20 to 50,000 ton per annum copper projects come in, whether it's Heap-Leach SXEW, well, it probably will be at that scale, the more the technology and the more the skill set builds up around that. And so it also becomes easier for the analysts and for the market to understand what the risks are, what the timelines are, what the upside is, and what the capital and the operating cost expectations are when you've got a healthier population of projects in development.
Yeah.
Goodness, I'm enjoying the conversation too much. I must think of the next difficult question to ask. When I look at their presentation and I see the open pit there, I mean, I can. How is the redevelopment relative to the existing infrastructure to the pit? Is it a big pushback? Is it a fresh site? Is Parks and Salyer? How does that change the timing of the development? What's the surface situation like?
Right. Well, I mean, the companies did a great job in increasing its land package from 2,100 acres to today 4,800 acres. So we have more than enough land to accommodate all of the leaching pads and all of the waste stockpiles and the ore stockpiles that ultimately will come to surface. So that's a good situation to be in. We did see, however, that in the initial draft pre-feasibility study that we've been working on lately, we saw that the best margins that we were actually realizing from our assets was actually Cactus East. And this was before we were building in Park Salyer. Now, Cactus East, just to give you an idea of the size and scale, it's 28 million tons at just under 1% copper. And that asset was giving our best margins when compared to the surface stockpile and the Cactus West pit, which includes a large layback. But when we look at Park Salyer and we consider just the leachable material there, we're looking at something that's 115 million tons at 1.06 total soluble copper in the ground. So from a size and scale perspective, it's almost 4 times larger than what we see at Cactus East. And obviously, we've got almost a 10% improvement in in-situ grade. So we think ultimately, when we bring Park Salyer into the equation, there's every likelihood that that will be our best margin asset. And therefore, when we look at the whole sequencing of the assets and what comes online first, there's every likelihood that Park Salyer would be mined first, followed closely by probably Cactus East. And in conjunction with that, we'd probably be mining the surface stockpile, given it's essentially a rehandling exercise, and that a lot of the costs have already been sunk from the ASARCO days into that stockpile. And what that ultimately then does for us is it really pushes out the open pit to a much later point in time. And there's some added benefits with that plan, in that with the underground mining coming ahead, obviously it means that we move less waste tons. So therefore, we don't have to use the full land package that we have. And because the underground ore has a higher sulfide or pyrite content, when it actually goes on to the leaching pads, it self-generates a weak sulfuric acid. And I'm sure all of the listeners are very well aware that in a heap leach operation, one of your largest cost drivers is sulfuric acid. And sulfuric acid is very much linked with, the oil and gas industry. And of course, we've seen prices, increase there quite substantially in the last 12 months with what's going on around the world. So that's driven up sulfuric acid prices. So a way to improve the model is go after the higher grade sulfide material with better margins and lower some of the operating costs, particularly from sulfuric acid. And I suspect ultimately when the PFS gets produced with Park Salyer in there, that's ultimately how it will play out.
And Park Salyer is an underground target? Yeah,
it's underground. The top of the mineralization occurs about 1,000 feet or 300 meters below surface. And we've got some intersections which are 200 to 300 meters in vertical thickness of over 1% copper. So, and it has a lot of continuity and is rather contiguous. So opens itself up well for some form of bulk mining. And I think initially we'll be looking at one area where there's a sub-level cave. And while we're opening up the sub-level cave, there'll probably be another area where we're conducting some form of long hole mining. But given those depths, it doesn't lend itself to being open pitable. It'll be a large underground mine.
Bulk tonnage underground. I can see in some of the of your material, you talk about enriched material and oxide material. And the enriched material seems to have a grade around 1% copper, and the oxide 0.7, kind of 0.5 to 0.7 in that range. But the oxide recovers really nicely, kind of above 90%. I think you used 93% in one of your news releases, and the enriched material has come down at 73%. Am I right in thinking that all of the kind of a lot of what you're talking about from Park Salyer is in that enriched material? And
that's correct. 90% of the tons at Park Salyer, given its depth, is predominantly enriched material. We don't have a large oxide cap there.
And the economics more or less work out that the higher recoveries from the lower grade kind of more or less equate to the lower recoveries from the higher grade. Do they more or less kind of match up?
Yeah, based on the preliminary work we've did at the moment, yes, they more or less match up. Higher grades at Park Salyer, but slightly lower recoveries than what we see at Cactus East, where the grades are a little bit lower. But as you said, we have more oxide material that's given us a 90% recovery.
And you said you had a kind of a draft of the pre-feasibility study. Now, when I have done pre-feasibility studies, it's normally associated with trade-off studies, looking at right sizing, scheduling, the whole variety of what it might be or what it should be, trying to find what it should be really in the pre-feasibility study. Yeah. Where are you in that process? And you've talked about possibly delaying the pre-feasibility study, or you had planned to produce it early, but now you're looking at producing it at some stage soon. You know, what are the critical path items and the thinking around your pre-feasibility study?
Well, the draft pre-feasibility study that we were preparing up until approximately 3 months ago was purely on Cactus. And at that point in time, we were doing exploration drilling at Park Salyer on 500-foot centers. And when we started to run our own internal resource models on Park Salyer, it became very evident that, you know, this, given its size and given the grade, it was going to be actually quite material.
Right.
And we had a conversation within the company, and obviously we involved the board of directors, and we indicated to them that we have the ability to put out a pre-feasibility study in the next 2 to 3 months purely on Cactus, but recognize that the market won't give us any value for Park Salyer because it's in an inferred resource category.
Yep.
And as you know, when you move into a pre-feasibility study, only
you can't include
indicated resources can be used, so they can convert over into proven and or probable reserves, which obviously have you know economic value. So a decision was made 3 months ago that we put the draft PFS on hold. Not all of the technical studies had been completed, nor had all of the capital costs been received for some of the fixed equipment and some of the mobile fleet. So we put that on hold, and we decided that we would drill Park Salyer out into the inferred category and put out a maiden resource estimate on Park Salyer, which we did about 6 weeks ago. And the plan of action now is to take that resource and just integrate it into the original PEA that we put out in August 21, just updating the resource section. No update to the costing, no update to the production profile or the financial and economic models, but purely the resource section. And that should go out to the market in the next week. And while we are doing this, we've now turned the drills to infill drilling to 250-foot centers, which will be completed by the end of January next year. By the time we get all the assays back, it'll be the second quarter of next year. But at that point in time, internally at least, we will have a updated resource on Park Salyer that should then be sitting in the indicated category. And between now and then, we'll be working on other aspects of a rescoped pre-feasibility study, particularly around Park Salyer, where in the second half of next year, we can then take that new resource model on Park Salyer, plus all the work between now and then that we would have completed, such as metallurgical testing and column tests on Park Salyer, geotechnical work to work out the stope mine design and the stope planning and sequencing, work concerned with hydrology and how we're going to keep the mine dewatered and how much water are we likely to encounter, so that before the end then of calendar 2023, we can come out with this rescope pre-feasibility study that doesn't just include Cactus, but also includes Park Salyer that we believe is going to be material. And as we sort of touched on, pre-recording, we think in the next 12 to 18 months, we should have worked ourselves through any economic downturn so that when we come into 2024, we can see an improvement in the general economy. And as we said earlier, you know, copper tends to be a bellwether for the economy. And if that happens, if that timing occurs, we could be releasing a pre-feasibility study that looks rather robust as we start to head into what I believe could be the beginnings of a super cycle in commodities that are associated with the green energy sector.
I was speaking to a fund manager a couple of weeks ago, and I said, I asked him whether he was worried about the China slowdown and the impact on the copper price. And he said, my goodness, we need it. You know, if you look at the demand profiles of copper, as you talk about through the green, the energy transition and decarbonization of our energy system, it would just need the demand profile looks so strong and the supply side looks so challenged through the lack of development and the falling grades in existing operations and the lack of reinvestment, that he said, my goodness, we need China to slow down. We need the slowdown in order to maintain some degree of long-term stability in the copper price. So it's quite an interesting dynamic. Because we see the softness in the prices, but actually, if you look at the physical and if you look at the stockpiles, and you look at the wider
flows,
the wider copper market, it's very very tight indeed. Moving on to one of your other shareholders, you've got Rio Tinto in there at 7%.
Yeah.
And in this summer, or 3 or 4 months ago, you signed this deal with them on Newton, this new kind of leaching technology.
Right.
Do you feel that their interest in you or in the company goes beyond the using you as a guinea pig for the leaching? And have they spoken to you about their minimum economic threshold projects or their minimum economic value projects, kind of their new approach to smaller projects?
Yeah, I think at this stage in time, they are genuinely only interested in the company because they want the opportunity to deploy this Newton technology on our primary sulfide, which is chalcopyrite in this case. And they want to take that all the way through to a commercial application so they can show the wider market that there is actually a place for this technology. I would say, however, that there is a possibility, and this is just myself thinking, that if the project gets larger and there are strong economic gains to be had for both parties, I could see a situation where they might want to step above and beyond deploying their technology. And where I'm sort of going with this as well is immediately south of us, there's actually another company called Ivanhoe Electric, which is Robert Friedland, who I'm sure everybody knows. Their maiden resource that they reported when they IPO'd that company in June of this year is sitting at 10 billion pounds of copper in the ground, of which some of that material is also primary chalcopyrite. And it's all part of the same copper porphyry system that we're mining. So, in my opinion, if you started to look at the two projects from a regional perspective, there's every likelihood here that you're going to be looking at something in excess of 20 billion pounds of copper in Arizona on private land with access to water permits in hand. And I think that would be extremely attractive to a senior mining company such as a Rio and a few others like BHP that are actually out there today, given the size and the longevity and the location of the projects.
Yeah, interesting. The bigger companies certainly do like the jurisdiction security. Their threshold investment is much smaller in a safer jurisdiction than it is when you're talking about kind of real frontier stuff.
Yeah, no, absolutely. And look, I mean, the number one and number two copper producers in the world are Chile and Peru. They tend to produce more concentrates, which ultimately goes off to China for processing through smelting and refining. And as we touched on earlier, China is a big player in the copper world and typically takes about 50% of the world's copper demand. But I ultimately think that those dynamics are going to change. The energy crisis in Europe is going to drive the European Union to accelerate decarbonization and move to green energy. And there's going to be more significant demand for copper and other commodities associated with green energy in Europe. And they're going to have to secure those critical supplies. And I think following that as well, North America, particularly in the US, will be playing catch up. But, the Americans are paying $5, $6, $7 a gallon of fuel at the pumps. They've never seen those costs before. And subsequently, we're seeing an increase for electrical vehicles in the United States. But it's not just the fact that an electrical vehicle car has 2 to 3 times more copper in it than your standard combustion engine. Think about all the charging stations that ultimately will have to go in. And, in the United States, a lot of the states themselves are responsible for their own electricity grid. It's not something that's regulated or managed federally. And a lot of the states have underinvested or haven't invested enough in their hydro system and the main transmission lines. So, it's one thing getting cars, but as the uptick in electrical vehicles continues, eventually it's going to feed itself into upgrading the national grid or the state grid to accommodate that additional demand for power.
Yeah, well, heaven help us if we
require a lot more copper.
Yeah.
So, I think China's influence in the copper space in particular is going to diminish as the rest of the world, including Europe and North America, take up that further demand. And, as well, like we see a lot more social unrest, let's say, in countries like Chile and Peru. And, that puts in doubt investment in those countries and, future supplies of these critical elements, particularly copper.
I could sit and talk a long time with you about my views on on renewable energy and green energy, but I'm certainly with you on the demand for copper in electrification. And I when I study the global fuel market and the energy market, I see it as being very hard to decarbonize in the short term. But that doesn't mean that there's not embedded governmental-led demand drivers. And absolutely, the outlook for copper, I'm totally with you, is very, very strong indeed. Thank you. It's been a fascinating conversation. I've managed to steer away from talking too much geology, which is a first for me. But could you just kind of getting back on theme? Let's talk about the cycle where you see your development phase, why shareholders or investors should be looking to invest into Arizona Sonoran now, as opposed to, you've got a Lassonde curve that you're fighting. Everybody's got, it's a well-known phenomenon that the next year or two are boring but important. If you could just kind of reiterate your kind of philosophy why it's worth it now rather than waiting 5 years until you're ready to start digging.
Yeah. Well, the company has already substantially de-risked the project. It's not your typical greenfield copper project. This is a brownfield site. It's a former producing mine. It was in production for 10 years. Therefore, the metallurgy, the processing, the recoveries of this system and deposit are very well known. We have water permits for the next 50 years, which are valid until 2070. We have an abundance of water actually in the ground right on our private property. And because it's private land, there are no federal regulators involved, only local, state and municipal authorities. And any permits that we've applied for over the last 2.5 years, and there have been quite a few, from the date of the application being administratively accepted until the permit is received, has always been under 6 months. So that's extremely quick when you compare that to other projects out there. And as we said, we have a PEA out. We are in a bit of a quiet period, as you rightly pointed out, based on the Lassonde curve, the fact that we're in the PFS and then we'll go into the bankable feasibility study. But to try and keep a little bit of excitement there on the story, we also have other exploration targets right on the site. And when we acquired this property in late 2019, the initial resource only on the surface stockpile was around 225 million pounds of copper in the ground. And over the last 2.5 years, the company has invested $40 million in the drill bit with exploration expenses. And we've increased that resource from 225 million pounds initially to 3.5 billion pounds in the PEA. And then recently now with Park Salyer coming in, we now have 6.5 billion pounds of copper in the ground. So at $40 million investment, that is under 1 cent a pound of copper as the discovery cost for the contained metal that we have in the ground here. And we think we need to continue exploring. And even in these tough markets, we do believe that for exploration teams that can continue to have success, the market is rewarding them. And Where we have the biggest opportunity is between Park Salyer and the Cactus West Pit. There's 1 kilometer of open strike length there. ASARCO did drill there, but the holes were only 300 foot in depth because essentially they were only condemnation holes. And we know the top of the mineralization at Park Salyer occurs about 1,000 feet below surface. So in these big copper porphyry system, you get these horse blocks, these thrust faults that can throw the mineralization up or down. And there is the possibility that between Park Salyer back to the Cactus West Pit at depth, there could be the same copper porphyry system existing there that's never been explored. Also on the northeast extension, ASARCO did drill there. This is immediately northeast of the Cactus East underground mine. ASARCO drilled there. They did hit the copper porphyry system. The best hole they had was about 47 feet of 3% copper. And we intend to follow up on that in 2023 with an exploration campaign.
And then it's great, isn't it? It's great when you get those historic things.
Exactly.
Sorry.
And ASARCO walked away from that because when they hit the mineralization at that time, they were looking for something that was near surface. It was open pittable. They weren't interested in pursuing an underground mine at the northeast extension. So they walked away, and they did exactly the same thing at Park Salyer. And then until recently, before Rio came to the company with the Newton technology to try and leach the primary sulfide chalcopyrite, anytime we have drilled below the pit and we've gone through the oxide and the transitionary material, which is a covalite and chalcocite, and the drill bit has moved then into the primary sulfide, we've always shut the drill bit down. So why drill the primary sulfide if it wasn't part of our business model to the full extent of the basement fault? But if the Newton technology shows signs of success in the first half of next year through the initial results of the column tests, there's a possibility then to drill the primary sulfide out below the pit all the way to the basement fault. And that could potentially add hundreds of millions, if not an additional billion+ pounds of copper in the ground in primary sulfide. So we think if we were successful in all 3 of those areas, there's a potential here to add another 2 to 3 billion pounds of copper, contained copper in the ground over and above the 6.5 billion pounds we have at the moment. And I think another reason why investors should certainly look at this company is that in US dollar terms, we have a market cap today of 100 million US dollars, no debt, 25 million Canadian US dollars cash sitting in the bank. Ivanhoe Electric, which is immediately south of us, they have 10 billion pounds in the ground. They have a market cap today of 900 million US dollars, of which about 60%, 70% of that valuation is ascribed to Santa Cruz, which therefore is about 550, 600 million US dollars of their market cap, is the deposit immediately south of us, which is a greenfield site. It's not a former producer. It's on private land. They haven't secured water rights just yet. They haven't produced any preliminary economic assessment or PFS. And it's easily 10 to 15 years away from first production. Yet here we are immediately north, and our market cap is 1/5 of that company. So there's a large valuation gap. And I think as we continue to market the company and deliver on our own goals and objectives, I believe that valuation gap is going to narrow with our values coming up.
George, what a great conclusion. You should be in a position where you can market this company. Oh, yeah. That's
part of my job, Merlin.
It is part of your job. No, these comparisons are very useful. The value creation through the drill bit is really important. In certain environments, it can be a boring time in the Lassonde curve, where it doesn't seem to accrue value as you de-risk your main project. But what you can't predict is when that value does get ascribed to the project. You just have to go through that work And as you de-risk it, you de-risk the investment case of the company. And as long as you maintain the capital structure in good order and of the company. And so timing is uncertain, but value is being accrued.
Yes, absolutely.
Good. Well, we better leave it there. But thank you very much. And it'd probably be good to reconvene after the Q2 or something, once you've got some more test work coming through, some more drill results, and definitely when the pre-feasibility comes out at the end of next year.
Yeah, absolutely. That was my thinking. We should see the first results coming out from the Newton testing, the column test, probably towards the end of the first quarter of next year. So it might be a good time to talk about that, and also what our plans are, given the budgets will be approved in late December, January for 2023, and maybe what we're doing from an exploration front at that point in time.
I'm sure the viewers would like to see that very much. Good.
Excellent.